Welcome to our webcast, The Fiscal Deal, What's in It for You. I'm going to talk today about the American Taxpayer Relief Act of 2012. I'm Vince Dallard, a tax partner with Battelle & Battelle, and I'll serve as our moderator today. Our speaker today will be Sam Hemmeter and Jackie Otto, who are both principals with our firm. Sam earned his bachelor's degree from Wright State University and his master's in taxation from Capital University. He has 17 years of experience, including 13 with one of the big four firms. Sam's experience includes tax planning and consultation with closely held and SEC clients in a variety of industries. Jackie, who recently joined our firm, earned a bachelor's degree from the University of Dayton and a master's in taxation from the University of Cincinnati. Jackie has 15 years of Big Four public accounting experience. Before joining the firm in 2012, she worked for Deloitte & Touche and Ernst & Young. She specializes in income tax compliance and consulting for individuals, estates, and trusts, and other entities such as family limited partnerships and private foundations. Put over to our speakers today, a couple of housekeeping items. Everyone online should have received CPE information this morning. I'll interrupt a few times throughout the discussion today to pose a couple of CPE verification questions. You could complete your CPE verification form and return to Lynn Coonley as mentioned on the instructions. We'll make sure that the line gets CPE for the discussion today. Second is the participant evaluation. We very much appreciate any candid feedback you have on our discussion today. One last item before I turn it over. You will be able to ask questions if you look in the lower right-hand portion of your screen. There's a section where you can type questions. We'll address those questions as they come in, and if there are some questions that we miss along the way, we'll try to follow up with those at the end of our discussion. With that, I will turn it over to Jackie.
Today about the fiscal cliff deal was passed last week, and some of the key provisions that are in that affect individuals, states, as well as businesses. Changes, provisions for individuals, and estate and gift provisions as well. This was passed last week, like we said, essentially at midnight on December 31st of last week, the Bush tax cuts sunset, and then at 2 o'clock in the morning on January 1st, that HR and passed it by 89 to 8 vote. Late day at around 11 o'clock p.m., the House of Representatives also passed this decision, and it was signed into law by President Obama the next day by Otto from his Hawaiian vacation.
So they've introduced a twist on the old saying that the pen is mightier than the sword. Now you can say that the Otto pen is mightier than the sword. I just had a little bit of humor into this situation.
Here talks about the things that the law did not change. And it did not change any of the Medicare surtaxes that were passed as part of the Patient Protection and Affordable Care Act, commonly known as Obamacare, and that was upheld by the court this past summer. The taxes of individuals receiving more than $100,000 for individuals or $250,000 of AGI. The surtax is on wages and self-employment income, and 3.8% surtax is on net investment income.
And just to chime in on that tax, the new tax on net investment income, we presented both before and after the election in early November quite a detailed slide deck on the Medicare tax of 3.8% on net investment income. If you have any kind of detailed questions about those or that tax, please refer to archives on our website. We didn't want to spend more than a few minutes on that today.
That didn't change was the sunset payroll tax holiday that occurred in 2011 and 2012 that temporarily reduced the employee portion of the Social Security tax from 6.2% to 4.2%. So starting January 1st of 2013, the Social Security tax returns to 6.2%, and it applies on up to $113,700 of wages.
And Jackie, one point I would add on this, for those of you that are fortunate enough to be subject to self-employment tax, this provision also impacts those that report and pay employment tax on the return. Previously, those individuals enjoyed a 10.2% rate, and I believe that's, or 10.4% rate, and I believe that's increasing back up as a result of this provision.
It'd be 12.4. Last year this legislation was passed, the IRS issued updated income tax withholding tables for 2013. Employers to begin withholding Social Security tax at the new rate of 6.2%. They said to begin utilizing these new withholding tables as soon as possible in 2013, but no later than February 15th. And they said to the extent Social Security taxes were underwithheld in the initial paychecks this year, employers should make the adjustment to workers' pay as soon as possible, but later than March 31st. Then what happened to individual tax rates? The income tax rate unchanged from the 2012 rates except for the highest tax bracket. And the tax bracket changes for those individuals earning more than $400,000 in taxable income or couples earning more than $450,000 in taxable income. Like the previous slide where we talked about the net investment income, that was based on adjusted gross income, whereas these tables are going to be based on taxable income.
Yeah, just to be clear and to clarify all of this, the Medicare surtax was enacted as part of Obamacare, which was really separate from the sunsets on the Bush, tax law, such that it's entirely separate legislation and an additional layer of complexity into the Internal Revenue Code.
And the capital gains tax rates, as well as the qualified dividends tax rates, will remain at the 15% level that they're at in 2012, except for taxpayers in that highest, for $400,000 for individuals or $450,000 for couples.
Yeah, just add that I think in terms of legislation, any positive, we're potentially steering at a qualified dividend rate returning back to 39.6%, absent additional legislation, plus the net investment income tax. So if there's anything that's a positive in all this, it's yes, dividend rates did go up, but yes, we did retain a fairly preferential rate when it comes to qualified dividends.
Then kind of highlights that one of the key items that we frequently encounter is a dividend being paid by a domestic international sales corporation, or a DISC, and the qualified dividend rate for people above the $1,000 tax income level, or $450,000 for couples, would now go to a maximum rate of 20%. It's still clear, the regulations were just issued on the surtax in early December of 2012, and they're just proposed regulations. It's clear whether the dividends will be subject to the net investment income rate of 3.8% or not. They could potentially be excluded because they're derived in the ordinary course of a trade or business.
Yeah, and this is somewhat favorable. As Justin mentioned before, we were somewhat concerned. We have many clients that export, outside exports, and take advantage of the DISC. What DISC is an advantage for them is that the dividend is taxed at the rate, whereas the commission, which is paid to the DISC by the operating company, is deducted at the highest individual rate of, in this case, 39.6%, or what was 30%. We were worried that rate arbitrage on commission and the dividend would appear such that the would essentially become obsolete as a tax planning vehicle. The good news is it is not obsolete. It is still favorable. The commission will be deducted 39.6% for flow-through operating entities, and the individuals will get income at a maximum rate of 23.8, even assuming the net investment income is, or the DISC is subject to net investment income tax, or the dividend from it is. So that's good news for our client base.
At this point, I'll step in with the answer to CPE verification question number 1. One of the significant changes, as we've been discussing in this legislation, is the tax treatment of qualified dividends. The answer to E-verification question number 1 is qualified dividend.
The next slide talks about the change to the alternative minimum tax for individuals. There was a pay to correct alternative minimum tax exemption for 2012 that did finally get passed as part of this legislation. So exemption amount for AMT for a person married filing joint is $70,750, and for an unmarried single person it'd be $50,600. Another change put in as part of this legislation is now that non-refundable personal credits can be used to the full extent against not only the individual's regular tax, but their AMT tax liability.
And one that's not entirely clear to us at this point is where this reference to non-refundable personal credits includes the R&D credit. We have quite a few clients that are patties that R&D credits flowing through to their individual shareholders, and historically the credit has not been creditable against AMT and has been carried forward, but it appears that those might be something that can be used now to offset AMT, but we're not entirely certain if that was intended, and we're going to have to wait until additional guidance is issued on this new law.
We had a come in just a moment ago. It says, is K1 income from a pass-through entity taxed at ordinary income rates of 39.6%? I think the answer to that is yes. Really, unless it's a qualified dividend or capital gains, income above this $400,000 or $450,000 if you're married, taxable income level will be the 39.6% rate, regardless of the source of that income.
The other comes back into play under the 2012 Taxpayer Relief Act is it permanently reinstates the P limitation, which is a limitation on itemized deductions, as well as the personal exemption phase-out. Both of the items had been suspended for a few years and back in play. But we had another set of thresholds that apply for the P's and the personal exemption phase-out, and that's $300,000 of AGI for married couples and surviving spouses, and $50,000 of AGI for unmarried taxpayers. Limitations will apply much like they have in the past, where itemized deductions have to be reduced by 3% of the amount by which the taxpayer's adjusted gross income exceeds the threshold. And medical expenses, investment interest, and casualty losses will be excluded and will not be subject to the phase-out. And then there will also be an exemption phase-out to your personal exemption amount, and that will be reduced by 2% for each $2,500 or portion thereof by which the taxpayer's adjusted gross income exceeds the thresholds.
My question is that there's also an overall cap on the reduction of itemized deductions equal to 80% of the itemized deductions? Okay. Yeah,
that's still there. The 80% cap is still there as well.
Comments on this slide. First of all, the AGI thresholds here of 300 and 250. Those, the bad news is this phase-out came back. The good news is those phase thresholds are significantly higher than what they used to be. So I guess in a way that's a good thing. The thing I was pointing out, in terms of this 3% itemized deduction phase-out, I heard it presented in another webcast. One of the ways to think about that is really for our higher income clients, it's really another 1.2% marginal rate increase. And the way you get there is you basically take 3% of the 40% marginal rate. So when we talk qualified dividends and capital gains, of a 20% rate plus perhaps the 3.8% net investment income tax, I think it's fair to say you can add another 1.2 onto that for an effective rate on those types of items of more like 25% when you take into account this phase out.
Effectively extended as part of the bill was the IRA contributions to charity. This expired at the end of 2011. So there was not any provision on the books that would allow you to make IRA contributions to charity. They actively reinstated it on January 1st, but put in two provisions that could potentially help taxpayers take advantage of this in 2012, even though the year is closed. The first allows individuals who actually took an IRA distribution in December 2012 to now contribute that distribution cash to charity before February 1st and to treat that as a qualified charitable distribution. The allows individuals to take qualified charitable distribution in January 2013 and treat it as if it was distributed on December 31st of 2012. That way you're able to use the $100,000 exclude for 2012 and 2013.
The twist on this benefit is that because the distribution from the IRA is excluded from income, the individual will benefit at the state level when they file their Ohio income tax return. So a nice little kicker there, if you will, on this exclusion amount.
That applies to return accounts now permits individuals to convert their pre-tax balances and their employer-sponsored retirement plans to designated Roth accounts under those plans. Any due would be subject to tax at ordinary income tax rates. Under prior law, you were able to do this, but the participant had to wait until he was eligible to receive a distribution from the retirement plan before he could roll the distribution to a Roth account in the plan. All are various provisions extending, expiring provisions, both on the individual side and the corporate side. The extent of the individual tax provisions include an extension of the deduction for state and local sales taxes, and the deduction of premiums for insurance that is deductible as qualified resident interest, extension of the exclusion of up to $2 million and cancellation of indebtedness income that can be excluded on the forgiveness of mortgage debt on a personal residence. This would expire in December of 2012. I heard some people talking at the end of 2012 about trying to get short sales closed so that they could take advantage of this provision before it expired. So it has been extended until the end of 2013. Just the above-the-line deduction for teachers' classroom expenses. The Act permanently extends the exclusion from income and employment taxes of up to $5,250 of employer-provided educational assistance. It extends through 2013 the 50% of adjusted gross income limitation for of real property for conservation purposes.
One little, I guess, comment, if you will, on the employer-provided education assistance. The $5,250 limit applies to specific qualified programs. We have a number of clients I know, and generally I would advise clients that if they can, to actually treat reimbursements of education assistance as a working condition fringe benefit. It's not near stringent as the qualified education program is, and there's no limit on the amount of excludable tuition.
Other extensions that apply to some of the provisions for education include an extent of the Coverdell education savings accounts, which are commonly referred to as education IRAs. They were slated to drop back from the $2,000 deduction back to $500. The $2,000 is been permanently. The American Opportunity Tax Credit, which applies for up to the first 4 years of higher education, has now been extended through 2017. Also extended until the end of 2013 is the above-the-line deduction for qualified tuition and related expenses. It permanently suspends the 60-month limitation for student interest deduction, so no longer a limitation on how many months you have to claim that deduction. The child tax credit has been made permanent. It was slated to drop to $500 per child. It's now been made permanent at the $1,000 level. Child care credit is a 5% credit rate, and it has been made permanent, and the expense caps are essentially $3,000 for one qualifying child and $6,000 for two or more qualifying children.
At this point, step in with CPE verification question number 2. As just discussed, one of the provisions in this legislation that impacts a broad group of taxpayers is the child tax credit. The CPE verification question number 2 is child tax credit.
The Act changed the tax rates for trust, just like the tax rates for individuals were changed. For all the tax brackets below the top tax bracket, there is no change to the rate. The tax bracket for trust will now be 30.6% rather than for 35%. And that is projected to apply to taxable income at a $11,950 level for 2013. So trusts are going to get hit with that 36% tax bracket at a relatively low taxable income, just $11,950.
And just to clarify, trusts are also subject to the Medicare surtax of 3.8% on their net investment income to the extent their increase that $11,950.
Yeah, one point that I think is a little unclear right now is when trusts will be subject to this net investment income tax in the context of having a pass-through ownership interest. We certainly have trusts that have an interest in LLCs and S corporations, and I think at least been suggested at this point that if the trustee is a material participant in the operating business, that it would not be subject to net investment income tax. But it's this point in the proceedings that there are varying opinions on the matter, and I think as we continue to digest the regulations and the Q&A around this net investment income tax, hopefully we'll get a little more certainty on that.
The other change in the Act is to the estate and gift tax area. As called, the 2012 estate and gift tax exemption amount was the $5,120,000, and the tax rate was 35%. With the Bush tax cuts, the exemption amount was scheduled to revert to the $1 million on January 1st, 2013, with a tax rate of 55%. The American Taxpayer Relief Act of 2012, the exemption is $7, and it's indexed for inflation, and it is made permanent. The tax increased from 35% that it was in 2012 to a tax rate of 40%.
This is a relatively favorable outcome. A lot of people, frankly, viewed this relatively high exemption amount as somewhat low-hanging fruit, if you will, for Congress and the administration to attack, and not, which is a good result, frankly, for high net worth clients and taxpayers.
Yeah, I guess the comment I would have on this, I think we had a lot of clients, and I'm sure there were a lot of other individuals and businesses out there that were running a fire drill leading into year-end to try to take advantage of the exemption amounts that we thought were going to go away. It looks like that crisis was for naught because we could have done the same planning in 2013 as we could in 2012, but we obviously didn't have a crystal ball and know that heading into year end.
What is permanently extended in the estate and gift tax area is the portability of the exemption amount between spouses. This essentially allows the deceased spouse unused estate gift tax exemption up to the surviving spouse. In order to preserve this portability, an election needs to be filed, and generally an election is by filing an estate tax return for the first spouse, and this is required even if their gross estate would be less than $5 million exemption amount, so that they wouldn't typically need to be filing an estate return.
We come in, somebody's asked that we repeat the comments that were made about the Qualifier Education Reimbursement Program. Sam, can you?
Yeah, not a problem. There are specific code provisions that apply to qualified education assistance programs. One that's referred to or was changed or renewed, if you will, as part of this tax law is one that's fairly stringent in nature in that it requires that the employer meet certain tests, and the amount that's excludable is limited to $5,000. I think it's $250. One thing that I've noticed quite a bit is that there's, assuming that education itself would qualify as what's called a qualified working condition fringe benefit, that's a favorable, taxpayer favorable route to go. Now, I'm going to get into the specifics as to what qualifies as a working condition fringe benefit, but it's just another exclusion such that if the employee's tuition would qualify as a working condition fringe benefit, the way to go is to treat it as that and not pursue a qualified education assistance program, because there is a cap on the amount of tuition that can be excluded.
Thanks, Sam.
Extended well in the estate and gift tax area is the generation skipping transfer tax exemption, and it's being kept the same as the estate and gift tax exemption at the $5 million indexed for inflation. Generation skipping transfers generally are taxed at the top rate, so they have a 40% tax rate. The Tax Act retains some of the rules for tax preparers and taxpayers in terms of GST deemed allocations are being kept around, and that generally is a provision that automatically allocates GST exemption to certain transfers to trusts that would be a generation skip. Generation skip is a transfer to somebody that's 2 or more generations below that of the donor. And are some favorable provisions that allow for a qualified severance, and that qualified severance will be to be utilized for generation skipping transfer tax purposes. On the side, one of the things in the Act is a rate, Section 179 expensing election amounts for 2012 as well as for 2013. The deduction is set at $500,000 for 2012 and 2013, and it would be phased out for additions that exceed $2 million. It can apply to off-the-shelf computer software as well as qualified real property, which would be qualified leasehold improvements, qualified retail improvements, and qualified restaurant properties.
Section 179 expensing election, generally when Congress enacts something like this, it's intended to incentivize companies to spend money on capital equipment. At least for me personally, this is one of the bigger surprises in the legislation, was that, not that Section 179 was extended for 13, but that was extended retroactively back to 1/1/2012. So clearly a significant taxpayer benefit for those clients that place in service less than $2 million of assets. I think certainly a surprise in the practitioner community.
The decision was that bonus depreciation at the 50% level extended through 2013 for items placed in service by December 31st. In addition, it retained an election to accelerate your ultimate minimum tax credits in lieu of taking bonus depreciation.
That's a tax favorable or taxpayer favorable legislation for C Corp clients with NOLs. They can actually monetize what otherwise would be a bonus depreciation amount, which does them no current benefit. So that's something to keep your eye on in 2013.
Other provisions that were extended through 2013 are the 15-year recovery period for qualified leasehold improvements, qualified retail improvements, and qualified restaurant property. Also extended was the 7-year recovery period for motorsport entertainment facilities, accelerated depreciation on business property on Indian reservations, and the election to expense mine safety equipment. The R credit was another item that was retroactively extended from 1st, 2012 through December 31st of 2013. Additions extended through 2013 include the Work Opportunity Tax Credit, the New Markets Tax Credit, the Alternative Fuels Excise Tax Credit, which generally a lot of people claim when they use propane and other fuels in forklifts and things like that. Tax credit for facilities that produce energy from wind facilities. So employer wage credit for activated military reservists, and an economic development credit for American Samoa. So those other credits that were extended through 2013.
At this point, I could jump in with the final CPE verification questions. One of the provisions, as Jackie discussed, that's historically expired each year but has been renewed by Congress, is the Research and Development Tax Credit. The answer to CPE verification question number 3 is R&D tax credit.
There are a couple of provisions that were extended that pertain to S corporations. The extends the reduced recognition period for built-in gains tax, and essentially that recognition period is 5 years, and it's been reduced from a 10-year period. The basis adjustment to stock S corporations that make charitable contributions of property, and it's the 100% exclusion for gain on sale of certain qualified small business stock.
Justification point on the S corporation and the built-in gains recognition period. The recollection is that these provisions are for made S's as opposed to S elections that were made in prior years. In other words, if we had a client that made an S election 8 years ago, would now no longer be subject to built-in gains tax, or window in effect retroactively be shortened. I believe if this is consistent with the similar provisions, that this is for newly made elections.
That's my recollection as well, but there's a lot of rules here that I haven't read for quite a while, and I couldn't say with certainty either whether that is how that worked.
Yeah, so I think if it applies like it did the last time this provision was put out there, for someone under the old 10-year built-in gains window, it did retroactively shrink that down to 5 years, that it was only for newly made S elections that were made during the window that the legislation was applicable for. In other words, to benefit anybody unless they made an S election or in one of the other recently eligible years and waited the 5-year period before disposing of assets.
That's my understanding. So
Congress did bid in this particular tax act, but they're not finished, because the things they didn't address were restoration, which generally is the across-the-board spending cuts that were to happen as part of the fiscal cliff legislation. Those have been delayed for an additional 2 months. The other hanging out there is we will soon be seeing legislation with to raising the debt ceiling that the country needs.
That's right, and just to kind of reinforce what Jackie said, I mean, what they addressed here was about a $600 billion matter when, in effect, we've got a $17 trillion problem. So I think that unfortunately, frankly, the news headlines and the media coverage over the next 60 days will be inundated with more news about how to handle that, and it will be interesting to see what comes out of that.
What was in comment, it was interesting to see just in the days after this legislation was signed, there was discussion about comprehensive tax reform. This is a significant piece of legislation, but I think that the White House in particular has already been making reference to the fact we aren't, quote, finished yet, and that some broader scale tax reforms may be in the works. So that, we have no questions in the queue, and if I could ask you to complete the evaluation form, we very much appreciate any candid feedback you have on the discussion today. If you have any questions that you did not get a chance to pose while we're walking through the information, feel free to contact either Sam or Jackie. Be happy to address those questions for you. And that we conclude our presentation. Thank you very much.